Deutsche Bank just issued a buy recommendation on Affirm Holdings AFRM, while Affirm is about to walk into a buzzsaw of a consumer credit market.
So the real question is, can Wall Street give us any insights as to whether or not this stock really still has a lot of upside, or maybe it's about to top out and things are going to come falling down?
Today on the Altimetry Authority. Let's talk earnings of
Like
favorite pastime.
So let me just say, earnings
Wall Street
is
2.5x
because their compensation goes up.
Wall Street's wrong again. So Deutsche Bank just resumed coverage of Affirm. For those of you who don't know Affirm, the buy now, pay later player that is doing everything it can to make sure that Americans can finance their purchases without realizing that they're financing their purchases. And look, when you look at what's going on for Deutsche Bank, right, what they just did is they said, hey, look, we are hammering that we're long Affirm. And yet, right, when you actually look at what's going on for their forecast for Affirm in terms of the buy, you can see anybody who looks at what the actual stock price recommendation is for Deutsche Bank or anybody else for Affirm can see nobody really thinks Affirm can go a lot higher than it is right now. Look, all those blue dots right there in this chart, those blue dots are the Wall Street recommendations. Not a single one of them is more than 20% higher than the current stock price. So what gives, right? Why is it that Deutsche Bank is hammering home the idea that they're so bullish on Affirm? It probably isn't what you think. Go ahead, Joel.
Yeah, so just to make a point, when the Wall Street analysts provide a target price, which they're required by law, they can't just say, I've got to buy, I've got to hold, or whatever. So there's 100% buy-hold ratings, but when they give a target price, that is a target price 12 months from today. 12 months from today. So when you say 12 months from today, if you think the stock market should do at least 10%, why would you buy a stock unless it could do at least 20? So our bogey is sort of like, if they're not giving a target price at least 10 to 20% higher than the current price, they don't really like the stock, because the market's going to get you that on average over long periods of time, 10, 11, 12% with dividends reinvested, right? You'll get that over time. So when you see a chart where it says, look at the target prices, you're like, oh, it's slightly above today. Slightly above is meaningless because it's supposed to be 12 months from now, right? So if the market's going to go up anyway, you better beat that. Otherwise, why would you possibly buy stock? So this is a big tell from the Wall Street analysts, like, despite their 100% buy and hold, for the most part, none of them really are bullish about this company.
Right, and any good buy-side investor, Joel, would tell you, hey, plus or minus 20% is a margin of error anyways, who knows? But there's a reason, everybody. Just remember, what Joel, the point that you made, Joel, right? One, what the buy-sell recommendation says in terms of what it's telling management and why they're being nice to management versus what the stock price target says. Well, why is it that Deutsche Bank wants to be nice to management? Well, if you know Deutsche Bank, you know Deutsche Bank has a huge debt capital markets business, a huge business in terms of helping people borrow money. And Affirm, right, they do buy now, pay later, which is basically they help you buy something and then you spread out your payments over time. They're basically acting like a bank. That means they need tons and tons of money to finance these operations. And they have these massive warehouse facilities. And what a warehouse facility is, not to get into gory details, but it's basically a way that they can easily draw money from a bank or from a lender so they can then finance that purchase and then they pay it back. Well, their amount on their warehouse facility has exploded in the last few years, right? From sub $2 billion to almost $6 billion. And Deutsche Bank undoubtedly wants a piece of that action. And so Deutsche Bank's trying to be really nice to them. But let's talk about what's really going on in terms of whether or not they actually believe in this company and what they actually see coming down the pike. Because, again, Affirm is in the world of consumer credit. So maybe there's a reason why Deutsche Bank and nobody actually thinks that Affirm really has a lot of upside. And that gets into not Affirm, but the general issue with the U.S. consumer. Right? We talked about this a few weeks ago when we talked about the idea of the student loan slow motion apocalypse. Well, the issue is you've got a whole bunch of consumers who now have debt coming due in terms of student loans that they haven't had to pay in 5 years. And that's stacking on top of the fact that you have a bunch of other consumer debts that have all been piling up. One of the things that we love to pay attention to here at Altimetry, I don't say love to, we insist that we monitor so that we know what's going on, because we don't love seeing a chart like this for consumers. It's not a fun thing to look at, but is how well consumers are doing in terms of paying back their debts. What this is data from the New York Fed. And the New York Fed basically goes through and says what percentage of total loans of different loan types, from credit cards to student loans to auto loans to mortgages, what percentage of them are 90 days delinquent, right? 90 days delinquent is when you're not just like you missed a payment and you're trying to catch up, you really are avoiding paying your debts. Well, we have seen credit card debt delinquencies creeping up really since the middle of 2022. We've seen auto loan delinquencies creeping up since the middle of 2023. And now student loans, which is that red line here, has gone from basically zero, because nobody was having to pay their student loans, to up to 8%. And anybody who actually understands what's going on here will tell you student loan delinquency rates are probably going to break 15 to 20% going forward. And so Deutsche Bank and everybody else, well, they're paying lip service to Affirm so they can get that flow of debt deals. They're looking at things like this and say, the consumer is really under pressure. And they're saying the consumer is really under pressure, and they're also looking at Affirm's profitability. Right? On an as-reported basis, Affirm looks like it hasn't made money any of the last 4 years. In reality, on a uniform accounting basis, it has. But here's the thing that's really interesting. What Wall Street is hoping for is that this company's earnings are going to inflect massively higher over the next 2 years. It's almost like Wall Street is basically saying, hey, we can't actually give this company a buy recommendation and tell you what we really think about this company's earnings because they're so bad. It's almost, it's effectively, they're saying, hey, we would be telling you they have negative earnings if we were telling you the truth. So we're going to give you, a nice picture here in terms of Affirm is about to have inflection in profitability. But even then, these white bars are what the market's pricing in. The market at a $22 billion market cap and a $70 stock price for Affirm is basically pricing in Affirm to get to return on assets of 11%, levels it has never seen before, and going into a buzzsaw of a consumer situation, right? I mean, I'm sure you've probably all seen the jokes of people defaulting on Chipotle mortgage-backed securities. This is what's going on here. And so anybody who's looking at this is going, hey, look, there is no way that we could possibly give a really, really bullish high stock price for Affirm because of the issue in terms of where valuations are and the macro situation they are. And so you put all that together, and that's why when we look at Affirm, we say, hey, look, we get it. Wall Street wants their money, right? They want to be able to make sure that they're making those fees from that debt issuance that Affirm has. But nobody in Wall Street really thinks that this company is a company to be bullish on. And that's why, quite frankly, it's not really Wall Street's wrong again. It's Wall Street's not being truthful with you again. So that's this episode of Altimetry Authority. Everybody, if you like this, hit the like and subscribe button. And feel free to drop us a comment. Thanks so much, everybody.
Thank you.